What we're going to be going over here is retrospective accounting change for inventory methods. And our example we're going to be going over here is we're going to change from the LIFO inventory method to the FIFO inventory method for our accounting. And when we make this retrospective change here, what we're going to have to do is we're going to have to adjust our prior year's financial statements as if the new principle had always been used here. So when we make our change from LIFO to FIFO, we have to restate our financial statements or recalculate our financial records here as if we've been using the FIFO all along. Okay, so before we get into our example here on this retrospective change, let's move over to some T accounts here and look at how what we're going to be looking at here and the effect that we have with our. This is what we're going to be looking at. We're going to have an inventory account here, and we're going to have some change in this inventory where when we make our LIFO to FIFO conversion here, a retrospective change. And what we have to do is that's going to, any change in our inventory here, we're going to look at how it affects our retained earnings here as an equity account here in our balance sheet. Remember, inventory here is an asset here in our balance sheet. So let's look at what we're going to be dealing with here. This inventory, anything that we use for the period is going to be charged off against our asset account in inventory here, and it's going to flow over into our cost of goods sold and our expense account here on income statement. And that cost of goods sold and expense account is going to reduce our sales revenue that we have on our income statement. So cost of goods sold is going to decrease our net income. Sales is going to increase our net income. And the difference between our sales revenue and our cost of goods sold and our expenses would be the net income for the period. And our net income here flows into retained earnings as an equity account here on a balance sheet. So what we really want to look at is the changes here. And what we want, for our example, we're going to really be looking at end of the year balances in our inventory account, looking at LIFO versus FIFO. So just going through our example here. Say, for example, we had $200,000 here sitting in our inventory for the year here. And then for FIFO, let's say we used $100,000 worth of that inventory. So net amount at the end of the period, we'd have $100,000 sitting in inventory. Now, looking at LIFO, let's just say we had used only $80,000 here for the period or for the year, so we'd have $120,000 sitting in our inventory account. So what we're looking at here is if we have a larger balance in our inventory account, say the $120,000 here for LIFO, that means you're going to have a lesser amount of inventory charged to cost of goods sold. Therefore, you're going to have greater net income and also greater retained earnings, and vice versa would be true. So let's just follow through our numbers here. I don't want to just see what's going on here and see how our inventory affects our retained earnings. Say, for example, we had the $100,000 used here, credit, reduce our inventory account, and then we debit or increase our cost of goods sold by $100,000 here for our inventory here for FIFO. Say we also had expenses here of $200,000. So we have a net expense here, cost of goods sold of $300,000. It reduces our, say we had sales revenue here, a credit of $500,000. So what we have here is expense, cost of goods sold less expenses subtracted from our sales revenue. The net amount here would be $200,000 would flow into retained earnings from the net income here for FIFO here. And now you can see what's going on here. Now, if we went down to LIFO, just say we had $80,000 instead here, we used less inventory here for the LIFO method, therefore we're going to have a greater inventory balance at the end of the period here or end of the year. And then let's just say we had $80,000 went into our cost of goods sold here, $200,000 worth of expenses. Take that from sales revenue of $500,000, so you're going to have LIFO is going to give you $220,000 here of net income is going to flow into our retained earnings. So you see what's going on here. You have to look at your changes. We're going to be looking at the changes here in inventory and how it affects our retained earnings. So that's what we're going to be looking at. Just understand this flow here, how our reduction in our inventory increases our cost of goods sold here, and that reduces our sales revenue, and then the difference between sales revenue, cost of goods sold, and expenses would be our net income. Net income flows into retained earnings. So you see how our inventory here is affecting our retained earnings. Okay, so let's move over to our example here. Okay, again, we're going to have a retrospective change from the LIFO inventory method to the FIFO method, and this is where we're going to make our adjustments to our financial records here. So what we're going to have, this is what we're going to have to deal with. We're going to have an inventory account here, and I've gotten shown here for 3 years here, year-end inventories here, a LIFO versus FIFO, and then we're going to also have our cost of goods sold. We're going to be giving our cost of goods sold here for those 3 years here, LIFO versus FIFO, and then we have the LIFO retained earnings here for each of those 3 years here. That's the retained earning balance at the end of the year here. So what we're going to have to do is we're going to have to convert our retained earnings over to FIFO, but what we're given here is LIFO. So the first thing we have to do here, and we're going to looking down here on our income statements for the year end, we have to restate our income statement here to FIFO. Okay, so let's look at that here. And I'm going to show LIFO here. We're going to have to also come up with our income statement for the year end here for LIFO. And we're going to use, and why we have the income statement here, what we have to do is we have to calculate our net income for each of those 3 years here, looking at LIFO versus FIFO when we have to make our adjustments. So let's say, for example, here, we're going to have, for example, here for each of those 3 years here, we're going to have a constant sales revenue of $8,000. This isn't thousands of dollars. This would be like $8 million. But let's just say we're going to have $8,000 here for each of those 3 years here. Then we're going to have cost of goods. We take our cost of goods sold here for the LIFO. Okay, let's look at what do we have here for cost of goods sold for LIFO. I'm showing $1,600, $2,000 for each of next. Okay, so let's just look at it. Let's go to our numbers here. Cost of goods sold here for year X1, we had $16,000 or $1,600 here for year 1. And year 2, we have $2,000 here for LIFO. And then year 3, we have $2,260. We have $2,260. Okay, so that's what we have. This is the only thing that's changing here on our income statement here. Again, for LIFO. And then we're going to have operating expenses. They're going to be constant here. Let's just say it's $2,000 for each of those 3 years. So our net income, we have to calculate that. Just take our sales here of $8,000 less our cost of goods sold of $1,600 here. Operating expenses of $2,000 is going to give us net income here for year X1 of $4,400. So do the same thing for each of the next 2 years here. Year X2, just take your sales less your cost of goods sold, less your operating expenses here, and your net income will be $4,000. And same for year X3, do your sales less your cost of goods sold, operating expenses, you're going to come up with your net income at $3,740. Okay, so we've done our income statement here for the year ending for our LIFO for each of those 3 years. Now, this is what is going to have. It's going to have to be restated here, our income statement for the FIFO method. And again, same thing. We got the sales, $8,000 here constant for each of those 3 years. This is what changes. Our cost of goods sold, now we go up to FIFO here. What do we have? For year X1, it was $1,640. Year X2, $1,880. And year X3 here, $2,200. So our operating expenses are the same here, $2,000 for each of those 3 years here. So netting out our sales here, or taking our sales of $8,000, looking at year X1, less our cost of goods sold of $1,640, less our operating expenses of $2,000, net income is $4,360. And year X2 here, if we gone through that, we would find out our sales $8,000, $1,880 for cost of goods sold, operating expenses $2,000. So net amount here, net income for the year here, year X2 is $4,120, and then the final year, year X3, sales $8,000 less our cost of goods sold $2,200, operating expenses $2,000. We come up with $3,800 here for our net income here for year X3. And what we're going to be just looking at, you can look at it here, year X1 net income here, $4,400 for LIFO versus a FIFO here, net income for year X1, $4,360. And you can make your comparison for each of the next year X2 and year X3 in the same fashion. Okay, so this is what we'd have to do. We have to restate our income statement for FIFO inventory method. Okay, and that all came off our, we had to know what our inventory account, or we had to know what our cost of goods sold was in this case. Okay, so now what we have to do is we have to add notes to our financial statements, and we're going to, this is where we have to look at our balance sheet here, our inventory account, and also our retained earnings account. We're going to have to make our comparison here from LIFO to FIFO, and we're going to have to look at the difference. We'll go through these here. And then we also have our income statement. We have to make our changes there, or we have to show what our changes were on our income statement. And here's the cost of goods sold and our net income. So again, we're going to be looking at LIFO versus FIFO and the difference. So let's start out here for our balance sheet, our inventory account. Now say for year 20X1, this is where we had that inventory here of 200,000. So let's just go back up here. So you can see our inventories here for LIFO versus FIFO. And okay, so LIFO, we had 200,000 here for the first year here, and then FIFO, we had 160,000 here. So you can see by changing to the FIFO, we have a difference here of 40,000, or a reduction here of 40,000. So that's what the comparison you're going to have to make in each of these years here. Inventory, LIFO 200,000, FIFO 160, so we have a difference here of 40,000. So now we can figure out our retained earnings here. Again, for year 20X1. Say our retained earnings, we started out here at the balance here. We can go back and look at it. For our LIFO inventory, we had a balance here of 2,200 sitting in our retained earnings account. So there's where we have for LIFO 2,200. Now we can calculate it for FIFO because it's just the difference here. Remember, we talked about the relationship between our inventory and our retained earnings. Since we had a reduction in our inventory here, that means we used more inventory under the FIFO method here, and that's going to give us, there was less remaining at the end of the period versus LIFO, so we have a difference here of 40,000 here, or 40. So we would subtract that from our LIFO retained earnings at 2,200. We're going to reduce our LIFO retained earnings here at 2,200 by 40,000, or 40 here, down to 2,160. So you can see our retained earnings went down here because we actually used more inventory. The 160,000 here versus 200,000, that's end of the year balances. So FIFO, we use more inventory. That's going to reduce our return earnings here. Again, we have to look at it by the difference here is 40,000. So our inventory goes down by 40,000 here. We use $40,000 worth of more inventory. We reduce our retained earnings here by 40,000. So same thing here for 20X2 and year 20X3. So let's look at our LIFO here for 20X2. Let's go up there here. So again, our inventory, you can look at it. LIFO was 400 versus FIFO here at 480. Okay, so you can see that here. 400 inventory for LIFO, 480 for FIFO. So we had an increase here in our inventory year-end amount here of, the difference is 80,000. So that means we used less inventory here. Since our FIFO inventory, our balance was greater here, sitting in our inventory account versus LIFO. So difference was 80,000 here. We used less inventory because this was our ending amount balance, making the comparison. So what is that going to do here for our retained earnings? So looking again, where our LIFO retained earnings, we've gone back up here. That balance for year X2 was 4,200. Okay, so that for LIFO here, but converting over to FIFO, we increase our retained earnings here by 80,000 here, 80 up to 4,280. Okay, so you can see what was going on here. We had more inventory at the end of the period here for FIFO versus LIFO. That means is we used less inventory. Therefore, we're going to have greater retained earnings because inventory here went into the cost of goods sold, and then the cost of goods sold reduced our net income, and then net income flowed into retained earnings. Okay, so you can see what's going on here, and then you got to make the comparison in retained earnings. 4,200, 4,280 here because we increased it due to the fact that we used less inventory here, so we're sitting with 80,000 here. So they balance each other out. And then year X3, same thing here. LIFO, let's go up there here. So our inventory was 640 for LIFO, 780 for FIFO. So 640 here, LIFO, it increased to 780 here for FIFO. That means is we had a greater end of the year balance here of the difference is 140,000 or 140 here. So How does that affect our retained earnings here? So beginning with our LIFO here, our retained earnings was $6,070 here. Okay, so that was our LIFO here for 20x3, $6,070. The difference was that 140 increase here in our inventory. That is, we had a greater balance of 140 or 140,000 here. So that increased our retained earnings by 6,210 here, 6,210. Again, the difference between our retained earnings LIFO here versus our FIFO, the difference is 140. So that's what we're looking at here, this relationship between our inventory and how it affects retained earnings. And we knew the retained earnings, what they were here for LIFO, and knowing the change in our inventory from LIFO to FIFO, whatever increase or decrease here increases or decreases our retained earnings. Okay, now the last thing we have to do, well, one thing we have to look at here is next for our income statement accounts, and that would be our cost of goods sold and then our net income here. So again, maybe we'll just go through these real quick here. So we went through our cost of goods sold before here, and let's look at that. Just moving down here, LIFO year one here, year X1 here at 1,600 versus FIFO at 1,640. So again, make your comparison here. Cost of goods sold increased here by 40 or 40,000, let's say here. So we had a greater cost of goods sold here under FIFO versus LIFO. 40,000 here. So what is that going to do to our net income? So our net income here, remember we calculated, let's go back and let's calculate. That was calculated up. Maybe what I'll do here is our net income, let's just go back here. That for LIFO we had at 4,400 here. That was for LIFO that we calculated versus FIFO was sitting at 4360. So that's 4360 over here. We moving up to our account here. So difference between on our net income, our cost of goods sold increased here by 40,000. So our net income here reduced by 40,000 or 40. 4,400 minus 40 here gives us 4,360 here for our net income. Okay, so that's what you're going to have to show here. That's why we made our calculations here for net income for both LIFO and FIFO for restating it. And then if we went through our other years here, it would be the same. Year X2, we were sitting with our cost of goods sold here at 2,200 for LIFO, 1,880 here for FIFO. So again, make your 2,000, excuse me. We had 2,000 here for cost of goods sold for LIFO, 1,880 for FIFO. So we had a reduction here in our cost of goods sold of 120 or 120,000. So what is that going to do to our net income? Well, if we go back and we looked at our net income here for the LIFO method here for, that was year X2, we can go back up here, that was 4,000 here, and $120,000 reduction here, 120 reduction in our cost of goods sold. Our cost of goods sold is reduced by 120,000, so that's going to increase our net income here to from 4,000 up to 4,120. So the change here in net income, we have a positive increase of 120 here. And then for year X3, it would be the same thing here. So again, just going down, let's just go down here. So looking at our cost of goods sold, year X3, we had 2,260 for LIFO versus 2,200 for FIFO. So again, make that comparison here, where our cost of goods sold actually went down here again for FIFO here by the difference of 60 or 60,000 here. So what is that going to do to our net income here? So if we've gone back and looked at our net income for LIFO, let's just go look at it here. That was 3,740 for year X3 here, net income. So we put that 3,740 here versus our FIFO we had at 3,800 here. It increased up to 3,800. So the reduction in our cost of goods sold here is 60. We knew what for our LIFO here, we're sitting at 3,740. So the reduction here of cost of goods sold increases our net income up to 3,800. Difference here, 60 or 60,000 here. Okay, so this is what you have to show here. You have to make your stakeout. Let's go back to it. You have to determine what your income statement for each of those 3 years here for LIFO, that we would have known here. But then we have to restate it, our income statement here based on the FIFO, what would change here with our FIFO. And we have to know what our inventory costs were, our cost of goods sold, and and also our LIFO retained earnings. When we had to make additional notes to our financial statements here, looking at our balance sheet accounts, making the comparison here for our inventory from LIFO to FIFO, and also our retained earnings, how that affected our retained earnings, LIFO to FIFO, the differences here. And then we also had our income statement accounts, those cost of goods sold and our net income here, looking at LIFO versus FIFO and what the difference was in how our cost of goods sold affected our net income. So what you have to do is you have to make these calculations and add them into your financial statement notes. Okay, so let's go down here and let's just say now our retained earnings after the retrospective application here. And I'm just using 20x2 and 20x3 to see how these flow out here. So what you would do is for retained earnings statement, you just take your beginning of the year balance, that would be the 20x2 here, that would be the end of year 20x1 here. Just showing a 2200 here, 2200. We had adjusted it for FIFO, that was let's just say we had a $40,000 reduction or 40 reduction here. So our readjusted amount was sitting at 2,160. We had net income for the year here of 4,120. Again, this is for LIFO here that we are adjusted to the FIFO here of 4,120. You're starting out with your retained earnings adjustment of 2160 plus your net income for the year here at 4120. So the sum total here is going to give you your retained earnings here for year end at 6280. Okay, so that's what you have to use. You have to make your adjustments here to your beginning of the year retained earnings, whatever your adjustment is, add in your net income for the year. That's going to give you your retained earnings for the year end. So what you would do here, you determine what your retained earnings for the year end here for year 20x2, and that becomes your beginning balance here for year 20x3. And say 6280 here becomes the retained earnings adjustment here for 20x3 of 6280, and then our net income for the year here under the FIFO method was 3,800. So add our retained earnings adjusted amount here plus our net income for the year here gives us the retained earnings for year end at $10,080. Okay, so that's what we'd have to also note here, that our retained earnings statement, how we have applying the retrospective application. I just used year 20x2 and year 20x3. Okay, so that's what you'd have to state here. Now let's go and let's look at one last thing here. Okay, and there's one other thing, the cash flow statement. We didn't go through it in this example, but there wouldn't have been any change in our cash flow statement. But let's go and let's look at one last thing here. Okay, what we're going to look at here is the journal entries to record the change from LIFO here to FIFO. And again, this is where we're looking at our inventory here as an asset here on our balance sheet versus our retained earnings as equity on our balance sheet. So this is really the journal entries for this change here. And this, we're looking at our inventory here. Again, we looked at the LIFO versus FIFO for year X1. We want to really look at the change here for each of those 3 years here. So for year X1, we had LIFO 200,000. For FIFO, inventory went down to 160,000. That was, so we had a negative change here of 40. And then each of the next years here, you can see 400 to 480, we have a positive change here of 80. And then for the last year, 640 to 780, we have an increase here of 40,000. So what we would do here, our total change, we have to determine our total change here for those 3 years here. So what that totals out to 180,000. So we debit or increase our inventory account here by 180,000. That means we used less inventory here, FIFO versus LIFO, because we have more here sitting in that end of the year or end of the period readjustment. We readjusted it here, so we have more inventory sitting here as an asset account. That means we used less inventory under the FIFO. And what that would do here, we had the debit here of 180,000 to our inventory, so we just have to adjust our retained earnings as equity on our balance sheet. We have to credit that here for the same, whatever our increase in our inventory was, that was 180,000. So retained earnings increased by 180,000. So that's really the journal entries that you had to make. Now, if the opposite was true here, where our inventory, we actually used more here in FIFO, then we would have had just the opposite here. We would have credited or reduced our inventory here, and then what that would do is that would affect our retained earnings. We would have debited or reduced our retained earnings by that amount. But here, for the journal entries on the change, just remember, all you do is take that inventory account here and compare your FIFO versus your LIFO and look at the net changes. LIFO went down over FIFO, then you would have used more inventory here we use more inventory here for FIFO, so that would have reduced our inventory, or it would have also reduced our retained earnings. And in the case here where you had where FIFO here of inventory was greater than our LIFO inventory, that means you had more inventory at the end of the period here, so that means you would have increased your retained earnings here because you would have used less inventory. Okay, so that'll take care of our example here where we had to make this retrospective accounting change for inventory methods, and really we just looked at the change from LIFO to FIFO inventory accounting. Okay, and we went over the changes that we had to make regarding our income statement here, and then our notes to our financial statement, notes to our balance sheet, and our incomes, and also our income statement. And also looked at a retained earnings statement that we had to go through. All right, so that'll summarize our topic.